The question of the day, and the question we're probably going to be asking ourselves for the next month or two, is what market are we in? What are we doing right now? What is happening? What is the stock market feeling? Are we in a bear market? Are we going to recover? Whatever it may be. Here's my honest answer. We are probably not going to know for another month or two. We're going to need more economic data. We're going to need more inflation data. We're going to need more information from whatever political administration. We're going to need more information, and then the market will decide. Right now, we are running sideways. We've already priced in some fears, some tariff fears, some bear market fears, whatever it may be. Some of it is priced into the market, and we can see that because last 5 days we're basically running flat. Actually, we've gone up a little bit because after the full-on panic sets in, there's always a little bit of a bounce. Now, that does not mean we're going to bounce right back up to where we were, but that's a little bit of people cooling off, people comprehending things, and then putting some money back in. But if economic data is terrible, whatever it may be, we're probably going to be going back straight down. So right now the market is waiting for more information, then it will decide. It will. A month or two or three, I have a very strong opinion that we will either A, be up, or we will have a time period where we were up, or we will have a time period where we were down. Probably somewhere in that 8 to 9 to 10%. We're very likely going to be, we're fine. Maybe some good tech earnings, maybe some good economic data, maybe some good inflation data, whatever it may be. We're going to go up, or we're going to get even more tariffs. We're going to have inflation starting to set in. I know it takes many, many months for it too, but we're gonna go one way or the other. I strongly believe that. We might go sideways, but if we're going sideways, we're probably down a bit from where we are today. We're probably not going to run sideways just from this. We're probably going to have more people panic, more selling, probably down another 10 to 12% if we're going to go in a bear market. Now, recession worries, I think that's a bit overblown. If we're talking about a legit recession, if we do, it's maybe a short recession. It's difficult. It's difficult. And honestly, you want my honest opinion? We're still sitting in a PE ratio of 25. We're still historically high. We are. Honestly, running flat for a year in the stock market, I hate to say this. I hate to get all you upset. It's probably not the worst thing that's ever happened. If some of those earnings can catch up, maybe we sit somewhere around the 21 PE. At this point, with the Mag 7 tech dominating so much, there's always going to be inflated PE because although we are seeing inflated PE, we're also seeing earnings growth like we've almost never seen before. Nvidia. Have we ever seen a company of that size grow that fast? Yeah, I'm sure we have. But have we seen that many? I mean, the growth that Tesla's had, not just stock price, but also as a company. The growth Amazon, Apple, Microsoft, Meta, all those. Meta was at freaking $90 a share. It's at 700 right now, and it's still one of the cheapest Mag 7 stocks in terms of PE. So we are seeing unprecedented growth as well, and that's always, in my opinion, going to lead to some heightened level of PE being higher. I just think that's going to be the case. But at the same time, it wouldn't be the worst thing in the world, in my opinion. I hate to say it, guys, but it wouldn't be the worst thing in the world if we ran it flat for a year. It wouldn't. I want to see my stocks go up. I do, but also for being reasonable, for being understanding, we're also going to be able to buy in at stocks at cheaper PE levels. It's normal and it's healthy in a market to see things go up fairly dramatically and down fairly dramatically. You could have bought in here, done very well, as long as we're keeping our head, on straight. Now let's go through a few stocks that are popular on my channel. I like these stocks. I've covered them before. People have found my channel off probably many of these videos. Probably maybe some of you guys have. TSM is my personal favorite company. If you've been around here a while, you know this. I cover them all the freaking time. But let's look into it. They're still flat over the last 6 months. They peaked around 220. They were down, I think, below 190, and then the bear market ensued, and obviously they've fallen from that as well because everything will. I really like TSM. Obviously, I own a large percentage of this company. I'm still up dramatically. I think my cost basis is somewhere around 110-ish. I do own a lot of it. If it was to fall, let's say to 150, which if we're going in a full-on tech bear market, it probably will. Just being honest, I would definitely start considering it. I know there was here, let's zoom out a little bit in 1 year. Right here. When we went from high to all the way lows, I think I did buy a share or two, which isn't that much, but I bought a share or two for that price, around 150, 155-ish. So I just knew it was probably going to go back up, and it did. So if we're going to hit that 140, 130 range, if I'm getting some TSM around there, I'm absolutely buying more. Even though it makes up a large percentage of my portfolio, it'll make up a lot less percentage of my portfolio. I mean, maybe if everything's really down that much, then maybe. But I like TSM certainly for someone who owns a lot already, around the 130, 140 range. I would consider maybe around the 150, depending on where I am financially, where the rest of the stocks are. If it's certainly just running there by itself, I would consider it more. Let's go at AMD. AMD, it looks even worse if you do the 1 year. It looks really weird if you do the 5 year because you're still up 170%. But also, a lot of people are disappointed in AMD. I think it hit around 90, high 90s, 96-ish. It's back up to 107. I see this probably running flat. Maybe if we go in a full-on bear market, probably to 90. Probably run around there, maybe 80. I don't see it going much lower than that unless we're full-on recession. You're probably looking at around 70. I do not know. I do not predict the future. But AMD, even at these levels below 120, maybe 115, I'm certainly buying. It makes up a decent percentage of my portfolio. I'm closer to, because I've DCA'd in so much recently, I'm getting closer to flat on it with my cost basis. I still do have many shares around 80, even a bit lower than that. So AMD is a stock that hasn't performed well in terms of the stock. The share price, the growth of the company has been doing fine, believe it or not. I mean, they're growing revenue, they're growing profit. It doesn't look like it because of non-JAP. They're growing specifically the data center segment. They're actually slaughtering in a good way. They're slaughtering on the CPU data center market, which is something that's important. It's not as big as the GPU market, but it's still big. And they're doing okay in the GPU market as well. They're getting slaughtered themselves, meaning they're doing very poorly with gaming right now. They're doing very poorly with embedded. That's not too surprising. You see that in STM. You saw a little bit in Micron. I almost said Microsoft. So not too surprising. I like AMD for the future. I would not be surprised if it ran flat for a year. That's how we do stocks. But AMD is always a stock where people get super in and super out. I mean, literally. You don't even have to believe me. Look at this. Super in, ran flat. Super in, super out. It hit 50. Super in, meh. Super in, super out. That's literally just how AMD goes. It's like a mini Tesla in that way. But it's still a good company beneath everything. So Cigna is a stock that I covered on this channel earlier. Maybe I upload this first. I don't know. I'm recording these at the same time. Cigna has done well. Will continue to do well. It is a stock that has a long track record of performing and performing at a high margin. High margin, a high performance level. You zoom out, yeah, it looks great. I mean, from lows in 2008, it was around 17. It's now at 322. In what, 16 years, something like that? I don't know. Something like that. Math off the top of my head. They're going to do well in a bear market. They did well in a bear market in 2022. They're hitting highs when everything was getting slaughtered. Cigna is a company I expect to do well in a bear market. It historically has. It did very good, obviously, in 2022 when things were not doing very good. Another company I expect to do well is something like Vici. It has a nice high dividend yield of over 5%. It was actually a little bit higher, but it's rose. Not that much. Well, I mean, it rose from 28 to where we are at 32. So it's actually been rising fairly steadily. But if rates remain higher, go higher, it's going to get hurt a little bit, but it'll still probably be running flat. I mean, even when we were seeing high inflation, it was doing okay. 2023 and all that. It was hitting highs in 2022 when tech was getting crushed, things like that. It's going to do well in a bear market. But if rates go higher, people are going to be able to put their money in CDs, get roughly the same dividend yield, and you don't have that super rare but real downside risk of something going catastrophically wrong with the company itself. That sort of thing happens, and versus having your money FDIC insured, it's a bit of a difference. Of course, obviously it's more liquid in something like Vici, but still. So there's a trade-off there, but Vici is going to do fine in a bear market, and for me personally, I hold these stocks. Anyways, all of these. A lot of people, probably you watching, wants to protect your money. Totally reasonable. I understand it. However, I'm a little bit on the younger side for one. Two, I'm a little bit more non-risk averse. That's probably not what I'm trying to say, but I don't mind putting my money in a company I believe in that's getting crushed. Because if you look at it, if you're putting money in AMD at 58 a share, right? It was very briefly there, but it was. People are so pissed at AMD. You'd still be up nearly 100% on AMD if you bought in at 58 a share. Same with TSM. Let's zoom out. They were all the way down here at 63 a share. You're at 176 right now, and you are not at your all-time high. Good tech companies, when they're getting crushed, everyone's out on them. Yeah, and this was a V-shaped recovery for these specifically. It was, but I would rather put money in value stocks when no one wants them, when the market's hitting all-time highs. This is when I was putting money in stocks like Cigna and stocks like Vici. Not because I didn't think tech is great. I love tech, but you have to understand the market and understand where it's going. I'm not parking my money in crappy value stocks. Cigna still performed well. It's still going to perform well in a bull market, but it's just not as attractive to people. And I know this because when I cover videos on Cigna, no one cares, which is totally fine. But I'm telling you, it's gonna do well. I mean, I can't predict the future. I'm not telling you what to do, but you know what I mean. This is a good company. Sorry, it is. Look at the chart. It's a good company. Sorry. So that's all I got for this video, guys. If you enjoyed, like and subscribe. Do daily stock content on this channel. I'll catch you next time.